Thanks for joining us for our webinar on the corn and soybean outlook and the delayed soybean planting decision that many of you are facing. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me this evening are my colleagues, Dr. Chris Hurt and Dr. Michael Langemeier, both of whom are professors in ag economics and also analysts of long stature and long tenure. So with that, I'm going to start off by talking a little bit about this afternoon's report, which was the Crop Progress Report. USDA releases those reports weekly during the crop growing season. And this afternoon's report was of great interest to, I think, all of us. USDA reported as of this afternoon, actually as of yesterday, that 92% of the corn was planted in the U.S. and 77% of the soybeans were planted. And in particular, as you look at some of the eastern Corn Belt states, on the corn side, Indiana was at 84%, Illinois at 88%, Ohio at 68%, and Wisconsin at 87%. And on the soybean side, soybean planting is really lagging, 64% in Indiana, Illinois 70%, Ohio less than 50% at 46%, and Missouri at 57%. Those numbers were not really unexpected, but nevertheless it does indicate and confirm just how far behind we are on planting. And in fact, on the 92% of corn planted data, maybe even overstates how much of corn has been planted relative to USDA's March 1 intentions, and we'll talk more about that later. Let's kind of review the situation a little bit. So as of a week ago, approximately 15.8 million acres, roughly 17% of the March 1 planting intentions were not planted to corn. On the soybean side, 33.8 million acres, roughly 40% of March intentions were not planted as of a week ago. As of today, as I just indicated, corn was bumped up to 92% complete. And I think one of our questions we're going to tackle this evening is, does that mean that roughly half, 47%, of that 15.8 million acres that we thought were unplanted last week got planted in the last 7 days? And how much planting progress was really made last week? I think one of the key points is to maybe have a little better understanding of how the U.S. Crop Progress Report is put together. It's really designed to indicate when farmers quit planting a particular crop, or in most years that means finished planting, but in this particular year it probably more appropriately could be described as choosing to not plant anymore, which is not the same as actually completing their March intentions. And what that really means is that when you talk about 92% complete on corn planting, some of that has embedded in it prevented planting. And that's really the key, because the market is trying to figure out, and all of us collectively are trying to figure out, how many acres are going to be enrolled in the prevented planting provisions program under USDA's crop insurance. And so let's think about that a little bit. And Chris, you put together a chart here which I think is pretty interesting. It's prevented planting acres reported from USDA's Farm Service Agency going back to 2007 for both corn and soybeans. And you've got a projection on the right-hand side for 2019. So talk to us a little bit about where those numbers came from and how you put that projection together.
Well, first, Jim, we'd say that the numbers from 07, the years are down at the bottom, 2007 through 2018, are what has been reported to USDA as actual prevented planted acreage. This is for the United States. So the blue bars on the left side are corn, and you see there maybe 3 to 3.6 million acres are the highest prevented planted acreage we've had in the United States. We've have a projection out here on the right-hand side for 2019, and if you ask, is it an intelligent projection? I think we don't really know at this point. But trying to go back and look at the amount of corn unplanted as of prevented planting dates and some other numbers that we've looked at, I came up with a number of 5.2 million. Now again, I think the trade probably a week ago that might have been pretty acceptable. Today, I guess I would begin to up that more given the acreage we're seeing in the report today, as well as the forecast on the rain that we have probably coming. But as we look at 5.2 million acres of corn, certainly would be substantially above what we've had before. I think we'll probably use the word an unprecedented year here in 2019. But if we're going to come up with a production number at this point, we have to have an acreage number. So we're going to start for discussion with a number like this, 5.2 on corn, prevented planting, and 3.6 million acres on soybeans.
So as you look at those numbers, Chris, that 5.2 on corn, and you compare that to history in round numbers, that's about 50% higher than we were in 2013, which was the previous record, at least based on the data going back to 07, which is as far back as FSA's made the data available.
Right, and again, this isn't a lot of data, obviously, to work with. But anytime you increase a record by 50%, that sounds pretty good. Yeah. Sounds like a big increase. So I think some would look at this number and say, oh, it's too high relative to history. But look at this year. It is an exceptional year.
Let's take a look at the data for Illinois, Indiana, and Ohio, because that eastern corn belt that we're in the middle of has been one of the hardest hit regions this spring.
Absolutely, and I think this really illustrates at least our projections for discussion and for consideration of our viewers. We look historically at about, in those three states on the eastern corn belt, maybe the maximum around 500,000 total acres of corn on the blue bars. And on soybeans, as you can see, a little over 400,000 acres is the most we've had. So we're talking about increases that are something in the range of 4 times or more prevented planting acreage this year. And again, we don't know those numbers. These are just sort of a best guess at this point. This is dramatic in the eastern corn belt.
Michael, you and I were talking about this earlier and thinking about the 8% unplanted on the corn acres, the 92% coming in today. And even if that number is accurate, and we kind of think it probably overstates what was really been planted in a more traditional sense, that's still a lot of acres, right?
Yeah, if you use those numbers, you could easily come up with preventive planting for corn in the 7.5 to 8 million acre range, if not higher. And so I think Chris would admit this. The 5.2 million acres probably a very conservative estimate at this point, and it could be quite a bit higher than that.
Yeah. So
yeah, I sure would agree with that.
Yeah. So we're going to walk through some numbers here, and Chris, you've looked at some details with respect to intentions and unplanted. So let's walk through the numbers a little bit.
Sure. And again, looking specifically at the eastern corn belt, Illinois, Indiana, Ohio, trying to take the projections that Michael's pointed out are probably going to be very conservative, and try to look at how many acres is that by state, but also the percent of intentions. And these are substantial numbers for the eastern corn belt. High quality land generally gets planted. And this year we're looking at, as you can see, from about 6% to well over 10% possible non-planted acres. Now, as we look at those numbers, of course, Illinois a little further ahead on planting, but near 10% on corn. That's an unimaginable number to me as a native of Illinois with that high quality land that they have. But as you go down eastward towards Indiana, Ohio, dramatic numbers. You heard the percentage planted today in terms of Ohio, but 15–16% possibly. So those are dramatic numbers. That has big implications for input suppliers. It's going to have implications for yields, obviously, as we think about potential acres not planted, yields being lower, and volume to handle for the processing and marketing industry. This is a big deal.
And I think one thing it's important to point out, Chris, is the fact that one reason the acreage estimates potentially going into prevented planting this year are unprecedented is because when we look at the historical data, that really just a dozen or so years going back to 2007, it's a different environment with respect to the way federal crop insurance works with the prevented planting payments. And in fact, this year, the prevented planting payments were set at levels that were relatively attractive because of the prices that were available, and also because we've seen more people take the higher insurance coverage levels, especially, for example, in Illinois.
Right.
Northern half of Indiana, the 85% coverage level has become relatively common, and that helps make the preventive planting payments more attractive and really encouraging people to look at it very carefully in terms of the net returns, which we're going to do in a little more detail later.
Well, I think that's right, and you really have a unique situation this year, not only with regard to the weather, but other major factors such as the crop insurance with those high prices back in the March guarantee as well.
All right, let's take a look at how this starts to translate into the national level. And again, you've taken those same numbers and worked your way through to come up with some estimates of what harvested acreage would really wind up being this year.
That's right. So let's start on corn. And again, if you're going to come up with a production number, you have to have an acreage number. So this is at least where we're putting the numbers at this point. We'll go back to the March intentions from USDA at 92.8 planted on corn. I take off the prevent plant, the number that we've all said probably is conservative, and Michael said maybe very conservative, 5.2 million acres. And then we have heard certainly incidents as corn prices over the last about 6 weeks have increased 20% more than soybean prices have changed. So this did encourage some places, particularly western corn belt, where they had opportunity to plant, probably to shift some acreage over from corn to beans. I've got a number there of 2.3 million acres, reducing corn acreage as well. So that's a total shift with prevent plant and shifting corn to soybeans of about 7.5 million acres. We end up with 85.3 million acres. If I had to place my guess, prevent plant is going to rise more. That will bring down the actual planted acreage more in the coming weeks and months as we work through this. Now, soybeans, a number of analysts have been saying in the past couple of weeks, will increase the acreage of beans with the shifting that's going to occur and some of the late corn maybe that gets shifted over to soybeans. As I look at those numbers, I think now we're seeing the prevent plant grow enough at 3.5 million acres that we have in our numbers here to be greater than the shift from corn to beans. And I have soybean acreage now dropping below the intentions in March. So I think that's just a phenomena really of the late last week and this week. I would say soybean acreage is now headed down.
And maybe exacerbated by the weather forecast we're looking at for the rest of this week.
And markets clearly watch those forecasts. And as soon as they're out, they're going to evaluate the impacts. So I think we're lowering bean acreage and probably will lower that more.
All right, let's take a look at what this starts to mean from more of almost a balance sheet perspective. We're not going to go all the way through the balance sheet, but we're going to come look at the supply side of the balance sheet.
Yeah, let's just kind of update some of the most recent USDA information and kind of where we're thinking numbers at this point. Start with the USDA May 10th. This was no weather implication kind of a set of numbers that they had. 92.8 million, that was the March intentions. Harvested 85.4 million acres. They started with a trend yield at 176 bushels per acre. So that's a 15 billion bushel corn crop. And importantly, stocks to use up around 17%. That's that 2.4 billion bushel carryout. Then June 11th, USDA did drop by 3 million planted acres. Yield, they dropped 10 bushels per acre to 166. Again, I think generally the trade was a little surprised. They dropped that number that much. But on the other hand, everybody knows that's an early projection. So there goes the 15 billion bushel crop. It's now 1.3 billion bushels less than that. When you have a 2.4 carry out and you drop 1.3 billion, you are changing that stocks to use dramatically, and that drops stocks to use on their budget down to about 11 to 12% stocks to use. They increased the price to $3.80. Now, updating that to today, using our acreage numbers we've talked about, which again, we'll say again, we think probably those acres on corn will come down as we see prevent plant become more popular. But I've used a 168, not quite down to the 166. Our very early crop condition report would indicate something on the models I use, 168, 169, again, with a wide range on that. Too early to really talk about that kind of model having much accuracy. But I'm dropping nearly another 500 million bushels out of that production, and that gets stocks to use down around 10% and gets us a U.S. average price that's, I have 467 a bushel. Now, if you think about how does that relate to a December futures, it never perfectly related, but I generally think December futures might average 10 to 15 cents above a U.S. average price. And so that puts us 475, 480 December corn futures for 2019. Now, tonight we closed at, December was 468. So I'm just a little bit above the market. So I think basically the market is in the ballpark of what is reality at this point. None of us knows what that reality is. There's going to be every day for the next several weeks and months trying to sort through both acreage as well as yield. And then there's the weather that keeps coming at us that's going to really be influential. So the point is we have a dramatic and major change in the balance sheet for corn, and it's real.
Yeah, and I think the corollary there, Chris, is to think about the fact that when you work through the numbers, it looks like the numbers you've just laid out are probably pretty close to what's been built into current market prices.
That's what I would say.
And if we see some additional reductions or some recognition that some of these additional acres did not get planted, or we see some additional indication that yields are going to be a little bit lower than that 168 range you were looking at, all of a sudden that creates some additional upside potential.
Well, I think that's right. And there remains a lot of uncertainty, and that uncertainty more than likely is going to continue for a lot of the summer.
Yeah. So let's take another look at some scenarios, because you took a look at some different yield scenarios, recognizing that the crop yield models are pretty variable at this stage of the growing season.
Well, that's right. And let's just start with the 168. That was kind of the base that I started from anyway, with a 13.2 billion bushel corn crop this year, and carry out at about 1.3, 1.4 billion bushels. And I think maybe the first point would just follow up on your point, and that is, as you start to potentially drop these yields, they certainly could go below 164, but you see we're at a point where even modestly lower yields, 2 bushel lower yields, gives us a pretty substantial increase in price, more than 20 cents a bushel. And if you drop those another 2 bushels, you get more than a 20% additional increase in price. So we're at a point in their balance sheet, in our carryover situation, where we have a lot of dynamics. Smaller production can really have a lot of dynamics, particularly to upward mobility on prices.
And this chart right here is using that 5.2 million prevented planted acres. If that increases a little bit, it would have a similar impact of the reduction in yield. And so there's just a couple factors here could really make corn prices shoot up.
And as you think about it, Michael, one of the things you and I usually talk about is the fact anytime you start looking at stocks to use ratios below 10%, you've created the opportunity for some real volatility, whether it be on the demand side or in this case, really on the supply side, right? As we bounce around, and particularly in the low end, creates some upside potential.
Well, I think it's right. And again, we have this uncertainty in the fundamentals. We're just not going to be able to get USDA to they'll measure them, but the way their reports are structured, it's really going to be September before USDA can probably get very accurate, and it's never perfectly accurate, numbers on both acreage as well as yield. So that says you have the uncertainty. The market will talk bullish. The market will talk it's too hot, it's too dry. Pollination's being jeopardized. So I think all this says is that there really is a little stronger probability for upside on prices than the downside. Will this weather change and suddenly be perfect for the rest of the growing season and keep frost away till November 1. Is that going to happen? We're going to talk problems on weather all summer long. We're going to talk, we don't really know those acres. Look at all these fields that didn't get planted. And we're going to talk on a cool morning in August. Is the next frost coming September 15th?
All right, let's take a look at the soybean side, because the picture is a little different there, and I think this chart that, again, you put together, Chris, helps illustrate that. So walk us through this chart a little bit.
Okay, and again, I think everybody knows the soybean story with the problems we've had selling soybeans, particularly to China. But look to the right-hand side, we have stocks to use down at the bottom, 25% stocks to use for 2018 crop, current USDA numbers. And what we recognize there, these other past years other than 19, which is the USDA projection over there on the right, everything to the left is the previous 8 or 10 years. And so what we see is just these extraordinarily large carryouts, up over 1 billion bushels of carryout. Now, to really get prices moving higher, as we follow that dotted line back to the left, what we're talking about now with the reduction in planted acreage due to prevent plant and some lower soybean yields is getting back maybe in that 17% range on stocks to use. And 17% does increase price some, but we have down there in the text, that gets us more in the high $8 range to low $9 on soybeans. Now, again, I think we three believe that planted acreage on beans is going to come down more, but we still have a long ways to go to get out to, say, 10, 11, 12%. That could get us back to $10 beans.
Yeah, I think the key point, Chris, is you look at that red line on your chart. On the right-hand side, that slope is relatively flat. So if you change a little bit and move to the left, you don't get a big price response. On the left-hand side of that chart, relatively small changes in that stocks-to-use ratio make a big difference on price.
When you tighten supply and people get worried about availability, they're willing to pay, and often willing to pay a lot if there's a very tight shortness, as we have in corn right now with strong basis in the eastern corn belt.
All right, let's take a look at futures prices. Here's nearby corn futures using the monthly averages, monthly high-low close actually for the last 5 years. And that's an interesting chart, and you've highlighted a couple of key points on there.
Yeah, just try to keep it simple. And basically, I think I'll make news today. Corn prices have been pretty low for the last 4 years. And if that makes the news, I don't think many farmers are going to say, I didn't know that. But what we see over here on the current, on the right-hand side, closing today on the nearby July at $4.55 a bushel, is we now have exceeded all of the high prices on nearby corn futures back through 2015. And the next level of highs that we would see is at $5.25. And that would be the 2014 highs, again on the lead contracts, up at $5.25 a bushel. Now, again, that doesn't say we will go to $5.25, but with all the uncertainty there is in the market, with an inability to really know what the fundamental numbers are, I think a lot of traders, a lot of farmers, a lot of decision makers go back and look at charts and say, well, there's the next resistance, $5.25. So I think that's what I would be thinking about. Obviously, look at more nearby charts. For producers, we always tell them, look at your individual financial situation on your farm. Had a couple of those emails today. Should I be selling today? And again, you have the outlook. But if the price today works for you, if it meets your farm management goals, there's nothing wrong with meeting your goals. So keep that in mind. But looks like upside potential. And then you go back to the left beyond 2014, and you're back to the highs. And again, I don't think we're talking anything like that, but a remarkable run we've had with a remarkable weather year so far.
Yeah, just thinking about it, Chris, if we get somewhere in that ballpark of that $5.25, that's going to be not quite, but almost a $2 move.
Yeah, and just remember, some people have a good-looking corn crop, maybe not in the eastern corn belt, but some people do. and that would be tremendous returns relative to expectations for sure.
Right. Take a look at the soybean chart, a little different chart. This is the July 2019 over the last couple of years, but still very instructive.
Yeah, and again, those 1050s, we all remember those. That was just the spring a year ago that we had $10 beans. And then we got into our trade issues. So look at the 9/13 close. This again is on the nearby July futures. And at this point, today we had a gap up, which on a chart is usually signaling, oh, something new, something big bullish. And again, it was the weather, it was the volume of rain in the eastern Corn Belt, and of course the forecast that continue those high levels of precipitation coming across the Missouri to Ohio area over the next week or 2 weeks. So at this point, I think you're really looking at that first resistance point at 950, up in that range on soybeans. And then you have, what would it take to get us back to 1050? And my answer would be knowledge that there really is damage, that we begin to get more feedback on those planted acreage or prevent plant acres. And then as we get into the growing season, what does the progress of the crop look like on a weekly basis? How much damage is there to yields? Then is that a possibility? It is in the possibility set we could get back on and above that $10 mark on soybeans.
And we seem to be kind of in a transition zone here the last few days in the futures market with a kind of a recognition that earlier in the season there was this assumption that we would not only plant all the soybean acres that were reported on the March intentions, but also that we would probably pick up some switchover acres coming from corn into soybeans. Now we seem to be in this mode of maybe we won't get all the soybean acres planted as you indicated, and maybe even a little larger reduction in soybean acres than what you suggested on your previous
That's
cable.
right. So I think the direction now is less acres, and my perception is that analysts have not built in a big yield reduction. That some of the numbers I've seen are talking like 2 or 3 bushels per acre. Now we don't know. We know soybeans are almost a miracle crop in their ability to recover and take the days and sunlight they have and do really well with yields. But I think the vulnerability is this is an exceptional weather year, and we could have a much bigger decrease than the market is already expecting on yield as well.
Yeah, not guaranteed, but that risk is definitely out there.
That would be my thoughts as well.
Yeah. Let's kind of wrap up the outlook session, and then we'll kind of switch over and start thinking about that prevented planting scenario that we were going to talk about. So let's walk through that.
Remarkable. 6 weeks ago, who would thought that corn prices would have to rally to cut usage? But that's where we are. We call that rationing of a short supply. The market, one of the functions of a market as we have in our grains, is to discover what price will it take as we go higher to ration back and get the usage in line with the amount of supply we have. So markets right now are only talking about the production. We know prices are determined not by just production, but by supply and demand, production and usage. And remember, our usage is generally on the weak side, on exports. In terms of the ethanol industry, margins have not been strong there. So we will have some concern when we get a better idea on supply, but I think most of the next probably 60 days, markets are going to talk supply, and that's probably friendly. Weather really matters. We know that. Everybody knows that for the rest of the summer. The point of weak demand, beans, obviously, weather is going to matter as well. And I think on soybeans, we just don't see the upside potential as a percentage like we do on corn. Everybody has talked about that. But I think a couple of things, maybe 3 things we've already talked about. Continued potential reduced soybean acres. Yields could be weaker than we expect. I put on here, everybody now in the market has turned away from getting a negotiated settlement with China. Could that be a surprise? And again, I'm not predicting that, But I think that's one of the things you see strong reactions when the market wasn't expecting that. And I think there's a lot of incentive for both China and the United States to get a negotiated settlement. If that would possibly work out, and as part of that settlement would be that China agrees to go ahead and take the beans they bought and have a fairly aggressive purchasing program as part of the negotiated settlement. That's what causes markets to change a lot when you get a big surprise. I'm not predicting that, but if it happens, I was the first to say it.
And so, Chris, I want to go back to your first point about corn prices needing to increase to a level to ration a short supply. Yeah. The other thing that we've noticed here, especially in the Eastern Corn Belt, but more broadly than that, has been the strengthening in basis. In fact, we have the crop basis tool on the Center for Commercial Ag chart, and if you haven't been looking at that, you should. Basis has exploded here in the last several weeks, and in fact, we've actually moved above historical averages here the last couple of weeks. So the strength in futures has been exacerbated by the positive basis news and actually made these cash bids very, very strong here in the Eastern Corn Belt.
Yeah, and multiple implications. One of those is that a number of farmers did hold on to a lot of corn this year. And I should say from last year's crop, it was a big crop. There is some tendency for some producers anyway to think about, I want to see next year's crop. If it's a short crop, my old crop will go up in value. So great value for those that held on, obviously. The basis is reflecting a shortage of corn in the local market at this point. And you say, how could we be short corn with over 2 billion bushel carryout? Well, it is a short-term shortage, and that is that farmers are both busy, have been spending their time waiting to plant, but they didn't want to be hauling corn. And ethanol plants and others continue to use. This has just come on in the last 4 to 6 weeks. So great advantage. I wouldn't expect that to hold in the long run, although we're going to have to see what size of production this crop is. But big advantage, without question, for anybody with old crop stocks.
We might debate that last point, Chris, because as you think about what took place in 2015, when we had crop production problems again because of too much rain, too much water, giving us a bit of a shortfall in the Indiana, Western Ohio market. We saw some very strong basis levels throughout that season, that crop marketing season, and I think we could be setting us up for a possible repeat of that.
Yeah, and we've been thinking for the last 4 years, you'll have carry in the market. That is, if you'll store another month or 2 months or 3 months, there'll be higher prices. You get a carry market when you have surpluses. And your point is, we've moved to shortages. That's what the Eastern Corn Belt basis is showing us at this point. And that if the crop is small enough for the 19 crop, shortages will continue. And generally what you see is you may peak on prices on corn someplace out late summer into the very early harvest period. And then some tendency maybe for prices to go down, cash prices to go down after that. Remembering that as you think about what's going to happen in South America, when you got corn prices up here, soybean prices down here, South America will begin to shift acreage pretty aggressively this winter into corn, and that will begin to reduce the problems of a short crop in the United States as early as next March and April. There's another big supply coming to the market. And that has implications for soybean price patterns as well.
Yep, sure does. All right, let's kind of switch gears here and think about the late planting decision. And so here in Indiana and much of the Eastern Corn Belt, the final planting date for full insurance coverage for soybeans is June 20th, just later this week. You can still plant and insure soybeans from June 21 through July 15, but your coverage is declining on a daily basis. It actually declines 1% per day during that period. And just to walk through the numbers again, if you haven't gotten used to this from the corn side, here it is on the soybean side. If you have the 85% coverage on an RP policy, that turns into 80.75% coverage because you take the 5% reduction, so that's where the 95% comes from, times the 85%, and it turns into that 80.75%. But you'd still pay the 85% premium, Michael. As you think about options, your current planting options are number one, go ahead and plant soybeans. You face the risk of reduced yields. Your insurance coverage, as I just mentioned, is declining 1% per day starting on June 21. You could take the full soybean prevented planting payment beginning June 21. One difference between this and corn is for everybody, it's going to be that prevented soybean planting payment is 60% of your original soybean revenue guarantee. And for most of us on the corn side, of course, it was 55%. On soybeans, it's 60%. On the corn side, you had the option of buying up to 60%, but we don't think a lot of people did that. And in that case, you avoid the soybean production variable cost. And that's important this year as it was with respect to corn, because on most of those acres, probably not a lot has been done, so there's not very many of those variable production costs that have already been absorbed. So that's kind of an important consideration in terms of a return. So Michael, let's kind of walk through an example, and I'll let you kind of walk through some of these details.
Yeah, we'll start with an example that's on high productivity soil, and so we're using a trend-adjusted APH soybean yield of 65 bushels per acre. Let's say we also are using the 85% revenue protection coverage level in the revenue protection product. Remember that the crop insurance projected price was $9.54. That was the February average of the November futures. Surprisingly high projected price, and so we do have a relatively high projected price for soybeans. That's very important as we walk through these examples. That price is not $8.50, it's $9.54. So that really impacts this prevented planting example that we're going through here. To calculate the prevented planting payment, we first have to calculate the revenue guarantee. So we take 65 bushels times $9.54 crop insurance projected price times the 85%, because we have an 85% coverage level. That gives us a revenue guarantee of $527. We multiply that by 60%, and we get a full prevented planting payment of $316. Just like we did for corn a week ago, we're assuming there's some land maintenance cost, in this case $30. It might be higher for your situation, so you'd have to subtract a larger amount. That gives us a prevented planting payment minus a land maintenance cost of $286. A relatively strong return. If you stop to think about it, and we're going to compare that return to some possible returns from growing soybeans planted relatively late, and so the bottom line here: a preventive planting payment minus land maintenance cost of $286. We'll compare this to the return above variable costs, or what we call contribution margin, in our budgets for growing soybeans.
Yes, let's just take a look at some scenarios. So the first scenario is to take the full prevented planting payment for soybeans and leave the land idle.
And our scenario 2 is crops planted, or soybeans planted on June 20th. Notice we're using a 25% decline in soybean yields. As we indicated earlier, there is a lot of risk planting soybeans relatively late. That 25% may not be that big. I mean, you can look at years in the past where we've had some late planting of soybeans. It wasn't 25%. But based on some information from Illinois and Indiana, looking at late plantings, we did come up with an estimate of 25%. I think the important point there, Jim, is that there is a pretty good chance you're going to have a fairly significant drop in yield, and so you should use something that's higher than 5% or 10%. I think that's very important to keep in mind. In this scenario 2, we do have full crop insurance because we're in that June 20th, that start of that late period for soybeans, and so there's no reduction in coverage at that point. Scenario 3, soybeans planted on June 30th, we're assuming a 35% decline in soybean yields, so more of a double crop soybean yield situation. Here, the soybean crop insurance coverage declines 10%, 1% for each day past June 20th.
You know, Michael, when you think about those yield declines, and we've discussed this quite a bit, it's hard to get a handle on those. The research with respect to planting data is a little
really thin.
Yeah, it's a little bit variable. And there has been some articles written in the last week or two talking about when you look at aggregate soybean yields across the nation and even on an individual state level, delayed planting doesn't seem like it's pulled down yields as strongly as what we've done here. But that's a little different scenario because that actually looks at total soybean plantings. And of course, some of those plantings, a significant portion of most of those years, were actually planted in a fairly timely fashion.
Yeah.
We're looking at an individual situation that says if you plant an acre of soybeans later this week or towards the end of the month, what kind of a yield are you likely to face, or what kind of a yield decline are you likely
On
to
those
face.
acres.
And that's a little different scenario.
It's quite different.
And on the other hand, you talk to people that double crop beans, and there are those years.
Yes.
They're not normal, but years where the double crop beans aren't distinctly different on yield from single crop beans.
So let's look at this in a little more detail, Michael.
So the variable cost for soybeans for preventive planting, we just have the land maintenance cost of $30. For scenario 2, we have $270. We're using a slightly higher seeding rate than we used on June 1 and before. Looking at the budgets for soybeans planted before June 1, and then we increased the seeding rate a little bit more on June 30th to get a variable cost of $274. We've got a reduction in soybean yield assumptions on this chart, and that gives us a soybean yield of 49 bushels for scenario 2 and 42 bushels for scenario 3. Remember, we were using trend-adjusted yield of 65 bushels in this example. So let's look at these scenarios one at a time. Looking at the expected net soybean revenue for preventive planting, we're looking at $286 per acre. And so let's see how that compares to scenario 2 and scenario 3. With scenario 2, we're using a November 2019 soybean futures price of $9.40. We talked about the chance of that increasing, but that we were using today's price. Jim, you might want to talk a little bit about the basis assumption that we're using here.
Yeah, that's a good question. So the basis numbers we're using are based really on some research one of our colleagues, Dr. Nathan Thompson, did with one of his graduate students in terms of forecasting soybean basis. And that work suggests that a 2-year average has been an optimal forecast in really going back over the last roughly 15 years or so. And so that is the 2-year average going forward here. And it's more negative than a lot of people would maybe expect. But that reflects how negative the basis was this past year. And as Chris was talking earlier, unless we resolve the trade situation with China, we might continue to see that kind of a basis. And so that's where the numbers came from. It is based on that model.
So using the 64 cents per bushel basis, using the 49 bushels per acre yield, we come up with an expected net soybean return of only $159. We can compare that directly to the net return for preventive planting, and we're quite a bit short, obviously. And so in this case, preventive planting looks pretty attractive. Let's look at scenario 3 next.
Yeah, so just for clarity, what that red minus 127 means is that
preventive planting looks better by $127.
Yeah, exactly. All right.
Scenario 3 looks even worse from a soybean standpoint because you're dropping the yield even more and you still have all those costs associated with growing soybeans. And so in this case, expected net soybean revenue is $94. And so there's a $192 difference per acre between planting soybeans on June 30th versus the preventive planting. Now, under all these expected net soybean revenue, we still need to subtract land vet, cash rent. If we have cash rent, we still have to subtract machinery ownership, and there's still labor costs there. And so keep that in mind when you're looking at these examples.
And just talk about cash rent as an example. Take the prevent plant, 286, and you said you'd still have to pay cash rent. This is high quality land. What kind of cash rent are you looking at? So that would
be 260, for example?
260.
So not much margin. The net return to land would be small even under the preventive planting
scenario. And that's nothing for machinery,
nothing for machinery or labor.
Overhead.
So we're in a kind of a tough situation here, to say the least.
So far we've looked at the 85% revenue coverage, which probably covers a lot of folks, particularly the northern half of Indiana and a good chunk of Illinois and parts of western Ohio as well. But as you think about the southern part of Indiana, southern Illinois, 75% coverage starts to become more common. And so we took a quick look at that. At 75% insurance coverage, that net preventive planting revenue drops to $249.
And again, that's with the higher yield. Now, if you had 55 bushel soybeans, it's going to be quite a bit lower than $249. And so we're just using these to illustrate the concepts. We encourage people to do something similar on their fields and on their farms.
Yeah, so really a couple of things to think about with respect to adjusting this for your own situation. One, obviously, use your own insurance coverage level, right? That's number one. Number two, if you've got some experience with respect to planting soybeans late on your farm and maybe you've got some better data with respect to what kind of yield reductions you might expect, we've laid out our assumptions. Your assumptions might be a little different, so that's one thing to think about. And then the last one is to think about what's taking place with respect to price, and we'll look at that a little more detail later. But nevertheless, you might think about some different scenarios there as well.
And I wanted to ask a question, looking at take, prevent, plant on these budgets with the numbers you have, $286 down to $94 if you have to plant clear out there at the end of June. Which one of those three is most certain today?
Oh, by far and away, scenario one.
Okay, so in terms of just general risk,
Yes.
taking the prevent plant is the bird in the hand?
Yes, definitely. Yeah, thanks for pointing that out, Chris. I mean, scenario 2 and 3, we're using some fairly big reductions in yields here, but it's possible that could be even lower. The soybean prices could be lower. The cost could be slightly higher, and so scenario 2 and scenario 3 have quite a bit of risk involved in those scenarios.
And there's an upside potential, is there?
There's well, risk
Absolutely.
goes both ways. There's usually a downside to risk and an upside to risk, and so there's certainly some upside scenario 2 and scenario 3 where there isn't.
But there has to be upside for them to come out equal to
Definitely.
just take the bird in the hand now.
And we'll talk about the upside here a little bit on the next couple of slides.
So let's think about what we're missing in this analysis, and it's a lot of things.
It's quite a bit.
Yeah, it's a lot of things to think about. So the first one, which I think a lot of people have questions about, is the USDA continues to indicate that to qualify for the Market Facilitation Program payments in 2019, you have to plant. That's been pretty unequivocal. I know there's been a lot of discussions around that, but so far it sure looks like you have to plant. That's the USDA official policy at this stage. That begs the question, how large will the MFP payments be? And USDA is not saying. So I think my best guess is they're going to be silent on that topic until after July 15th. So as a producer, though, you're left to make a decision, and you've got to think about, well, what could happen here? Well, let's just think about the possibility of having an MFP payment of $50 an acre. That isn't going to offset, if you think about those budgets we had on the previous page or on the previous slide, that's not going to be enough to offset the difference between the prevented planting payment and what you could earn by planting soybeans. So if you got $50 an acre from the MFP program, by how much do soybean prices have to rally to make planting soybeans competitive with prevented planting payments? So there's an easy way to do that, and I took that 127 loss from that first column on or actually the middle column on June 20th, minus the $50, you'd have to make up $77. You divide that by the yield expectation, which in our case was 49 bushels. That implies that soybean prices would have to rally roughly $1.50 from the level we had on the slide, which was $9.40. That would put you up pretty darn close to $11.
Mm-hmm.
Now, Chris, that's not impossible, but that's a fairly optimistic soybean price forecast,
that's right? That we would guess that will not happen, but again, it could. It's in the probability set.
You could also, the basis could be a little smaller than what we're illustrating here, but that's not going to get you a long ways either. Even a 30 cents would be a big change from what you're looking at here.
And I continue to come back to the point, you're starting with a deficit. You've got to get some positives to overcome this deficit.
Right, exactly. Second option is if you plant under crop insurance, you qualify for the harvest price option. We talked about that at some length when we were talking about the prevented planting option on corn. This is not as big a deal for soybeans as it was for corn, and the reason is we're not as optimistic, or we don't think there is as much upside potential on the soybean side as we do on the corn side. So the odds of the harvest price option kicking in and boosting your insurance coverage on the corn side was quite a bit higher than what we think it is on the soybean side.
And let's just look at the projected prices again. Talk about the projected prices again. It was $4 on corn. Well, Chris was talking about the possibility of $5 or $5.25. That's not guaranteed by any stretch, but there's certainly the possibility out there. That's what we mean, that this is very important for corn, this harvest price option. But the projected price for soybeans was already $9.54. Well, yeah, that could be higher at harvest, but it would have to be substantially higher for this to really change your decision on the previous slide.
Yep. And then the last point, which is a little bit like corn, if you plant soybeans late, you are going to wind up pulling down your APH in all likelihood for 2020, because whatever your harvested yield number is does go into your APH calculations for next year. Keep in mind it is a 10-year average. It's probably not going to have a huge impact, but it is likely to pull down your APH for future years. So with that, I think that kind of wraps up our discussion, and we hope that this has kind of helped you think a little bit about the options you're facing here at the tail end of the 2019 planting season. And we know it's been a challenging situation for many of you, and we hope this information is helpful. As you think about it, we do have, the slides will be available on our website. They're actually not out there at the moment, but they will be out there tomorrow morning. You can download the slides and maybe use that to work through some of the calculations that we were looking at. And we also have some links out there to some really good crop production management videos from our colleagues in agronomy and weed science, which you might want to tap into as well. And so with that, thanks for joining us this evening. On behalf of the Purdue Center for Commercial Agriculture and my colleagues, I'm Jim Mintert.